Hi everyone, welcome back. Let's talk about how can we combine the bonus depreciation strategy with cost separation and how we gonna do that and use that after a 1031 exchange. In this video, we're gonna touch very briefly about bonus depreciation and then touch very briefly on 1031 exchange. And we're gonna outline some example how these two strategies can work well together. Stay tuned for that. If you are a homeowner or a real estate investor that you are about to sell your home in the next week or the next month and you are not sure how much capital gain tax you have to pay, or if what kind of strategy that you can use to defer or mitigate the capital gain tax so you're in the right place, I'm putting together a course. So do sign up in the description with the link to sign up for the early bird special. And for this course, I want to be very hands-on and really help you with the tool, the exact amount of tool that you need, because these topics are very huge. So if you're gonna spend hour and hour looking and do all the calculation, you might get into analysis paralysis. So I'm putting together this very condensed, very structured, step-by-step course that help you to, first thing, help you to calculate capital gain tax to see how much you own, and then second thing, help you explore 1031 exchange and combine with other strategy like bonus depreciation and cost separation. The goal of the course is to help you achieve all that in the shortest amount of time because you are under a time crunch, right? I'm an enrolled agent with over 15 years experience. I'm helping countless real estate investors to minimize their taxes and increase their deduction every year. You are in the right place. When you are a real estate investor, a lot of time we think or we learn so much about how to manage the property, how to acquire the property, and all other aspects, right? But then we forget about our number. We forget about the tech advantages, right? About the bookkeeping side, the expenses side, how to control your expense and increase your profit. So that's why you are here, to really understand different tax strategy and understanding the number side. So I applaud you for that. So first thing first, let's talk about bonus depreciation. So bonus depreciation, why the IRS or the government really want us to use bonus depreciation? Well, in the end, they give you a tax cut to try to stimulate the economy, to help you buy more and purchase more this year, right now, instead of delay into the future. So you can take advantage of the more beneficial tax treatment, save more on bonus depreciation, but also from the government standpoint, they help stimulate the economy and help to buy more. So when you buy more, it helps stimulate the economy. So we had the whole playlist series on bonus depreciation and section 179 depreciation. So do check it out, subscribe so you are notified when the new video come out. And then we also have another playlist on 1031 exchange. So do check that out as well. So the 1031 exchange is named after section 131 in the Internal Revenue Code. So basically, before the Tax and Job Act, there's a lot more property that you can do 1031 exchange, which is considered, like, basically the tax term is like-kind exchange. But after the Tax and Job Act, a lot of things change too. So only real estate is still qualified for the 1031 exchange. So some of the key aspects of the 1031 exchange are, first, to qualify for 1031 exchange, the property have to be used for trade or business, so it cannot be a personal property. And it has to be a real estate property. And second, the 1031 exchange is very rule-bound. So the IRS have a lot of rules for the 1031 exchange. So we have to follow all the rules, otherwise you risk being disqualified. So one of the key qualifications is that you have to use a 1031 exchanger. So when you hear a lot on social media, anywhere else, that you have to use qualified intermediary, well, technically you need an exchanger. And the IRS have definition of what are the requirement of an exchanger is. So you don't really have to use a qualified intermediary as long as you have an exchanger that meet all the qualification of the IRS, right? But why going through all that troubles? Because this section is very rules bound. So you want to make sure you have to cross all the T and dot the I and make sure you meet all the rule and qualification, right? So it's way more convenient to use a qualified intermediary. But also, anybody really could be a qualified intermediary. There is no test to take. There's no education requirement, not like enroll agent when you have to take the test from the IRS and you have to study a lot and know the tax law. There is no qualification like that for qualified intermediaries. So it's beneficial to use them because they're supposed to be the expert and they're supposed to meet all the qualifications, but you still need to do your own due diligence to select the right one. 1031 exchange is really a gold mine for a real estate investor because you get to defer capital gain tax. Could be ever and ever if you decided you're not going to sell and then just pass the property down to your heir, so they get a step-up basis. So 1031 exchange is very powerful. They have a lot of rules, but many investors doing that, and we are helping countless investors do that as well. So if you need more specific guidance on your tax situation, do go to the contact us in the description. So you can schedule a time to talk with one of the tax experts on our team. So now let's talk about some example that how some of the strategy can work together, right? So the first step is to select qualified improvement property that it can be eligible for bonus depreciation, right? So when you look to buy a new property or improve your current property, think about a tangible personal property that might meet the qualification for the bonus depreciation. So they have to have a depreciable life of 20 years or less, but it cannot be less than 1 year, right? Because with less than 1 year, there's no depreciation needed. You just take it as an expense. And also it's important because the tax law changes all the time. So definitely check the current tax update. But if you don't have the time or you're not sure, so do contact one of the tax experts on our team to have specific guidance for your situation. So for step 2, you can calculate and claim the bonus depreciation. So after you acquire the property, you can start list out all the property that could be qualified for bonus depreciation. So this is where cost separation come in handy. If you're able to do a cost separation to section these out, then you can depreciate them under a shorter term. If you can section these out, and then you can take the bonus depreciation on it. So the next step, if you consider to sell the property, so consider doing a 1031 exchange. So this way, you can defer the capital gains that if you be able to sell it well above what you bought it for. But also one of the key important is when you take regular depreciation, when you sell it, you have to recapture that depreciation anyway. So that's one thing, right? And then the rate of the depreciation recapture is your ordinary income tax rate, but it's capped at 25%. And then for any accelerated depreciation that you took, like when you take the bonus depreciation, right? So that's considered accelerated. So when you sell the property, all those items, the couch that you bought, the TV, the appliances that you put to your Airbnb, and then you sell it, and then that extra part that you took at the bonus depreciation on top of the straight line, then it's going to be recaptured at ordinary income tax rate with no cap. So just say your tax rate is for federal at 37%. So the regular depreciation, that the calculation that would fall under the amount for the straight line that you were supposed to take or allowed to take until you sell, going to be capped at 25%, right? Even though your already income tax rate is 37%. But the accelerated part, the one on top, going to be taxed at the ordinary income tax rate that you have, so that's going to be taxed at 37%, so that's a lot. So 1031 exchange is not only allow you to defer the capital gain tax, but it also put a stop on the depreciation recapture, so it kind of keep it there in whole, right? If you sell the property, then you have to look at all of these structure, anything when you sell the property that you 1031 exchange into. So, but if you, when you do 1031 exchange, if you can plan it, at least, try to keep holding it or keep exchange it, and then leave it to your heir. And then you are effectively not just defer your capital gain tax, but you also be able to eliminate the depreciation recapture as well. So basically, you're hitting two birds with one stone. So that's why it's such a wonderful strategy to use them in combination. So another step that you want to consider when you select the 1031 exchange property that you want to exchange into, that you want to look at from the lens of a real estate investor. A savvy real estate investor, you want to look for qualified improvement property that I can use to take bonus depreciation on that. So basically, it's like a whole wheel. And basically, you keep repeating process. You take depreciation, cost segregation, do all that. And then you keep 1031 exchange and you keep repeating it. So we're at 2023 right now, and the bonus depreciation is at 80% for this year for item placed in service for this year. And it phased out pretty much all gone in 2027. There is some talk this year that the government might looking back at bonus depreciation, and hopefully they're going to extend it. So stay tuned for that. We're going to do some more update when that come into law or there's any new update on that. So subscribe to our channel so you are notified of new video and update coming out. Or you can also subscribe to our newsletter. The link's going to be on in the description. Thank you and take care. Mahalo.